So I thought today was one of those videos where I come out and say, these are the days where you guys need me to do these videos. You know, when I always say when the stock market goes up, you don't need me. The days when, or the times where the stock market gets tough, this is where I need to be. This is where I need to kind of just say my piece of everything's going to be okay. And I thought today, once again, is one of those days after the week, or especially the last 2 weeks, I would say in particular, of just utter bloodbath everywhere. I felt like, okay, we need to do a bit more of a talk, a bit of a team talk about what's going on. Will everything be okay? And my thoughts on the current stock market. And today's one of those days where we do that. So yeah, we'll go through everything because at the moment it's a bloodbath everywhere. Unless you own Coca-Cola, which in my opinion, the only stocks that are doing okay at the moment are the ultra defensive stocks like Coca-Cola, for example, or if you sell cereal or toothpaste, and even some of them are at crazy valuations. The only thing that's really safe at the moment is the defensive stocks. Anything slightly aggressive, anything slightly growth is just unbelievably not wanted in the stock market right now. And the more you are into that sort of direction, the higher risk that you have with your business, it is not wanted and it's been absolutely decimated. So yeah, it's a bloodbath out there for a lot of stocks. And I thought today I was potentially going to do a video on HIMS. I was going to talk about HIMS, I was going to talk about their earnings. That's just another one, the stock's something down. I can't remember, I looked a couple of hours ago. I think the stock's like down 8% or something today. It was up after hours, after their earnings, like 10%, and it's had like an 18% swing on the most ridiculously good earnings. DraftKings was decent, but HIMS earnings, they were unbelievably good. They were one of the strongest earnings I've ever seen. And let's not forget that was off another, previously 3 months ago, another fantastic earnings. And the stocks just broke 52 close today. And that's just the market we're in. And I feel like at some point I will, hopefully tomorrow, I'll talk about HIMS and do a bit of a breakdown of their earnings. But it's a stock that kind of sums up what this market is at the moment. And yeah, I'll save that one for tomorrow, but that's one that will sums it up. And I know if you guys will want me to talk about that one, but I'll talk about that tomorrow. And I guess the ultimate question here is, will it recover? Will a lot of these stocks here, will we see the S&P get to new 52-week highs? Will we see the Nasdaq get to new 52-week highs? Will we see a lot of these businesses, Google, Facebook, PayPal, even some of the slightly risky ones, your high growth companies, maybe your DraftKings, your HIMS, will they ever recover? So I think the big thing to remember here is, what does history tell us? What does history tell us with stocks? Well, as long as you have a business and that business improves its financials, forget the share price, as long as it improves the financials with profit, with revenue, more than likely that stock will eventually be rewarded and that share price will recover. It's what happens. As long as the company keeps improving its financials, profit and revenue, or if it's more focused on revenue and it carries on that path to profitability, it will do well in the share price. That's what history says. And every time there's been a major point, a major disruption in the economy, what has the stock market done? Well, through that period of time, it might have had a bit of a wobble. But in the longer term, if you zoom out, what happens? It recovers. 2 world wars, major events, probably the most major events in probably the history of the stock market. What happened? It recovered because businesses come back, revenue and profit grows. If you bought in the World War II dip, which I'm sure no one watched this video, but if you did, you'd be up in them positions. One of the biggest terrorist attacks in the world, 9/11, massive terrorist attack. People worried, okay, is this going to change the economy? Is this going to change the dynamic? Is there going to be major wars that happen after this? What are the repercussions? Stock market was closed for a few days after that, and when it happened as well, I think it dropped something like 10%, or when it all happened. If you bought in the dip, it recovered. The Great Depression recovered. The Great Recession, very recent one. We're only 14 years ago in that one. Massive dip in that recession, and what happened to the stock market? It got crushed, but it came back. A lot of the stocks in 2008, if you look where they are now, they're a lot higher. And even after that, there was repercussions of a double dip recession. The fears of that happening, and what happened? It recovered. 2020, I'm sure a few of you guys that are watching this went through that one. What happened there? Pandemic, world shut down. Never happened before. We entered the unknown. What's this going to happen? Businesses shutting the doors, not operating at all, not even a little bit of operation. people not allowed out of the house. What happened? Massive recovery. So when I look at history, what does history tell us? Whatever the issue is at the time, it recovers. Most of the stocks in that situation, as long as they're doing well financially, will recover that situation. And you look at the pain that's going on right now, what's causing a lot of the pain at the moment? Well, there's a few issues, you put it down to, obviously we've had high valuations, but now we're back down at companies that are the lowest valuations they've ever been at for years. You're talking stocks that are at the metric, whatever metric you want to use, are the lowest metrics they've been for 4 or 5 years. You've got inflation, which obviously year over year looks incredibly high and is adjusting for the economy opening up from the last kind of problem that we've had, which is obviously the pandemic issue. You've had inflation that skyrocketed, but now you look, if you look over month, it's actually starting to level out a little bit. So that's obviously one issue. Interest rates. People are panicking over interest rates. Let's not forget, interest rates are still historically incredibly low. And even with interest rates of 7-8%, the stock market still perform phenomenal. So let's not get over this interest rate being a massive problem. People talk about a recession. I mean, you go out there at the moment, sure, there's a few issues of, as always, people say that this issue's happening. Generally, people are still out there, being locked up for 2 years, allowed to go wherever they want now. It's not too bad economy-wise. Sure, there's a few issues at the moment, but it's not too bad. You've got the Russia-Ukraine situation. Obviously, that's causing a few issues on the world right now. But is that going to stop Google, Microsoft, DraftKings, HIMS from putting in record amounts of revenue and profit? It's not. And that's a big thing. A lot of these issues right now, you look at some of these issues and then you compare it to the issues that we've had previously, and you're thinking, these issues are nothing compared to what we've been through before we made it out the other side. And the most incredible thing as well with the issues that we've had is that you look at some of them issues and the stock market, dived mass amounts of percentage. You look at some of these issues right now, they're not really, obviously there are a few problems, don't get me wrong, and they are affecting companies' financials slightly. But they're nowhere near what we've had and come through out the other side. And when you look at the dip that it's caused, you're talking about so many stocks down 50, 60, 70, 80%. And you look at how much these stocks are down and you look at the issues and go, is that really justified with the issues? Not really. So when you look at that point of view, we've had a lot worse situations recover from here. And the crazy thing is that we've had the stock market now pull back, so much on issues that sure are causing a little bit of headwinds, but what's priced in now is mass amounts of a dip at the moment. So I think that a lot of stocks are very much priced at very good valuations right now. And when you look at the outlook, in my opinion, I'm very bullish on what headwinds are there and what that sent a lot of valuations down to. Next up, growth stocks. I've seen a lot of negativity to growth stocks. Growth stocks are definitely the ones that are massively getting heat right now. Because why is that? Why are growth stocks getting so much more heat than value stocks? Well, the reason why is because they've dropped more. Instantly, what are investors? Investors are, a lot of the investors that are not successful are emotional investors. So what do emotional investors do? Emotional investors don't look at businesses. They don't look at the businesses they're invested in. Emotional investors look at share prices. If the share price moves up, the emotional investor is happy with that investment, not bothered about what the actual business has done. When the share price moves down, the emotional investor is angry at that business, they're disappointed, they want to sell the business because it's gone down in share price. What's happened with the business? Nothing's changed. So a lot of the emotional investors at the moment, and there's a lot, I would say half the investors that invest in the stock market are emotional. Half the people out there, half the emotional investors out right now, have changed from 12 months ago being very happy, these businesses are absolutely amazing, growth stocks are absolutely amazing, to now growth stocks are the worst thing. And why is that? Well, emotional investors. The share prices are now losing so much more percentage. And that's why they're getting so much heat. Because growth stocks are down so much more. Unfortunately, that's the game. Growth stocks are considered higher risk stocks. They're classed as high risk stocks because they have the potential to go down more than other stocks. But they also have the potential to go up more. Where was the negativity for growth stocks a few years ago? Didn't exist. Why is that? Because growth stocks outperform the whole market. Massive amounts. You look at growth stocks in that CV dip. If you bought growth stocks in the CV dip, massive amounts of return. You wouldn't have seen any negative comments about Square 12 months ago. What do you see about, say, a company like Square now? A lot more negativity. People call them trash stocks. They only call them trash stocks because they're down the most. It's as simple as that. And they don't understand the risk to reward with a growth stock. And I think the best one to me is, a lot of, I'd say, value investors that are negative to growth stock going, well, obviously it's a terrible stock because it doesn't make money. And well, that's not why you buy a growth stock. A growth stock is the potential of what it's going to be in the future. It's projecting on what its revenue potential can be in probably a very growing TAM, and then potentially what the profit could potentially be further down the line. You'll see a lot of value investors now saying that's the terrible companies because they work out what the profit they're doing at the moment, and they'll do discounting free cash flows and go, oh, look, it's a terrible company. Well, obviously, because it's not focused on the profit. So you're trying to value a company, a growth company that's focused on the revenue, on the profit, when they're not focusing on that, obviously it's going to look terrible. And the great thing about a lot of value investors that will be very negative on a lot of growth stocks at the moment is because they do. The thing that makes me laugh the most is because they'll focus on something like that, and then what you'll see is a lot of value investors will be saying, oh, instead of buying this horrible stock, you know what you're going to be buying is Alibaba. Now, nothing against Alibaba because I own shares in Alibaba, but this shows you, this is the market we're in. A lot of these value investors at the moment that are very negative on the market that you might see, and very negative to growth stocks, and they're potentially, and what I'd say as well is on the YouTube scene in particular, a lot of these value investors that have been hyped up recently, that have been trashing the market and have suddenly gained a following because these stocks are finally down after 12 months. What I'd say to that is, you look at a lot of them, and a lot of them were saying, oh yeah, Alibaba's a great buy. What's Alibaba done in these last few months? It's gone from $200, $300, down to $80. Just shows you. A lot of things down here are massively down. There's a lot of stocks. It's very hard to avoid the dip that's going on at the moment. Whether you are on a profitable company, a lot of stocks have been hit hard. Like I said, it's only really the defensive stocks that have been really holding up that well. Same again, will they recover? I think so. As long as these companies carry on, growing the profit, revenue, or grow that path to profitability, they will do very well. And as long as those financials keep improving, they will recover. And like I said before, a lot of these stocks are down huge amounts, and people are going, oh, is it ever going to recover? You got to remember, these growth stocks, stocks do generally go down a lot faster than what they go up. But as well as that, a lot of these growth stocks, they do go down a huge amount, but they are growth stocks. So that means they do recover a fast amount as well, which is important. And I think, a lot of people are looking at a lot of stocks and going, you know what, I don't want this risk stock here. I don't want this highly risk growth stock at the moment, which is fair enough. You might realize you don't suit them as an investor. One of the errors to make though is that looking at a growth stock and going, oh, I don't like that stock, and then not realizing we are in a negative market. My judgment would be, when you see the S&P at 52 highs, when you see the Nasdaq at 52 highs, and let's not forget, it's only recently that them indexes have come down so much. People have only really noticed this bear market in the last 6 months. If you've been in small caps or growth stocks, this has been going on for 12 months. It's been going on a lot longer than this. And the only reason why is because a lot of these growth stocks and small caps have been down here for 12 months. They've been beaten down, and finally when the big tech comes down, the thing with a lot of these small caps and growth stocks, they've come down even faster. They've carried on going down with the whole market. So a lot of them stocks have been beaten down for a 12-month period now. But what I would say is this, is that when you look at a lot of these growth stocks and small market cap stocks, rather than going, oh, you know what, these are just terrible stocks, what I would say is look at the whole market. When you have the S&P 500 putting you 52 highs in, when the Nasdaq, when the Russell, when these indexes and not individual stocks, when they are pushing 52 highs, and then you re-look at some of these growth stocks, and let's say that these growth stocks recover, obviously that turned out that it was just as being beaten down with the whole market. I would say that the time to be judging a lot of these growth stocks that are beaten down now is that if they're actually terrible companies, is then when we do get the recovery, which I think will happen, if they are still beaten down at really cheap valuations, then probably you've got a bit of a problem there. And that's what I'd say on that one. So will they recover? I think a lot of them will recover, but unfortunately you won't realise which are the winners until we do have the recovery. And let's not forget the big thing with a lot of growth stocks. The growth stocks in particular are stocks that they have the higher potential, the higher reward. This isn't the likes of a Google or Meta, which could potentially 2x in the next 5 years. When you're buying growth stocks, you're looking at the potential that some of these stocks could potentially 5x, 10x in the next 5-10 years. If some of these stocks, and you're averaging down on them positions, and they 5 or 10x in the next 5-10 years, how many losers that put up with? You could potentially have one stock that lands big time. One stock. You might have a portfolio of, 15, 20 stocks. All you need is one stock. Obviously have a diverse portfolio, but you'll need one growth stock in there. If you have 15, 20 stocks and you have 5 stocks that are a little bit more risk on, you only need one of them to land big time, and you're laughing. And you could have out them 5 stocks, you could have 4 stinker stocks. And if that one stock 10x's, it far performs and recovers the 4 stinkers you have. And people forget that, which is really important. And I think down here, these sort of valuations, you are justifying that you are more likely to get that choice here. And I'll talk about that in about 1 more minute. Next thing, don't listen to the negativity. Like I said, there's so much negativity out there. So much. And why is that? Where was negativity 12 months ago? It didn't exist. Why did it not exist 12 months ago? Because stocks were up. Now stocks are down, the sentiment's changed. There's a lot of negativity. Emotional investors, they're following the emotion. Stocks are down, so they're emotional. They hate the market. Every stock's terrible. Short the market. That's where the sentiment is. Didn't exist 12 months ago because stocks are up. Same again, let's say the stock market flips in 12 months and goes up again. Where will negativity be? It'll disappear. It won't be there. They're like, oh, actually that stock was actually a really good investment. I should have bought that dip. Same with the CV dip, negativity. Oh, the pandemic's going to last for a long time. They're never going to recover them. What happens? Boom, recovers. Negativity is gone. You don't see it anymore. We rotate all the time. It's stock market cycles. We're down here now. Eventually we'll go back up again. Where will that negativity be? It won't exist. And it's rife at the moment because stocks are so beaten down. So don't listen to negativity. Don't listen to negativity that's judging the stock off the share price. Look at the business. I see it everywhere. I get it in YouTube comments. I don't even read my YouTube comments now because there's so much negativity in there. Because people are seeing the share prices go down. I don't know if it's just because they enjoy giving someone grief on the YouTube comments. I don't know if they're angry because they're down. I don't know if they're angry because the stock's down. I don't know what it is. But they just need to vent that out somewhere. And I'll get it in my comment section. If you go on the Yahoo Finance, if you go on Stock Tweets, whatever, Seeking Alpha articles on the comment section, there's just so much negativity. You could be looking at a very good business there, and there'll be people just so negative on it because that share price is down. And right now, you need to be really avoiding the noise and focusing on, okay, which businesses are fantastic here that have lost so much share price, and that will recover. Because like I said, if you can find the gem, if you can find that one gem, and everything else goes wrong, which hopefully everything else doesn't go wrong. You might get 1 or 2 that goes wrong, but hopefully you don't have too many that goes wrong. But if you can find the one gem, or if you get 2 gems right now, you're going to be absolutely laughing, and you'll do very well in the stock market. So don't listen to the negativity. Now's probably the time to really focus more than anything and start thinking for the long term and start looking at valuations, start looking at the growth, look at them businesses. Is that business growing? Is that business growing revenue? Is that business moving that path to profitability? Are they growing the profitability? That's what you need to focus on. And last thing, what am I doing in all this? I'm buying. I'm buying and buying and buying as much as I can. It's hard. I ran out of cash a long time ago. It's very tricky to keep buying. But I am trying to buy as much as I can, whenever I can, and buy the dips and get the average lower. Because like I said, at the moment, what do you have? You have stocks at the lowest valuations they've ever been. You've had growth stocks lose 50, 60, 70% of the value. And now more than ever, this is the time. This is the time where if you're going to get a stock that could potentially be that 5x, 10x, is when that stock was $20 and now it's $4. Because already, if you get your average really close down to $4, you've already got a 5x back up to $20. And let's not forget, if it was at $20 and it was not too badly valued, and that was a year ago, and it keeps on growing in the next 5 years, you're setting yourself up for a big return. 5x, 10x. There's a lot out there. Loads. There's a lot out there. It's a bit like shooting fish in the barrel at the moment. There's stocks that I don't own that I'm looking at and going, that's a 5x in the next 5 years. Because there's that many out there. And it's hard to kind of justify which ones I actually buy at the moment because there's that many good opportunities out there. But there's plenty. And that's what you really need to focus on. And like I said, I'm trying to buy the ones that I think have the most potential for that reward when we have the return in the stock market. Because some of these businesses at the moment, well, some of them Some of them are going to be beaten down here forever, Peloton, but some businesses just keep smashing it. And what's that? What are those businesses being rewarded with? Lowest valuations it's ever been in 4 years, growing faster than what it has done. It's improving its profitability year on year. Those are the businesses you need to be looking at. Lowest valuations, growth, moving in the right direction. Those are the chances what you want to be looking at right now. So that's what I think on what's going on at the moment. Hope you enjoyed it. If you could hit the like button, if you new, subscribe. I'll see you next video.